Okay, I think I'm going to start here. Thank you again for coming to the webinar that we're putting on here. Appreciate everyone's feedback as we do this. Again, please know we're accountants and we are not. We're still learning this process, trying to get information out to you. I'm going to start here a little bit with the fun disclosure that I have to do, and please know the information on this webinar is general information. It should be viewed as applicable to your, and not be viewed as applicable to your individual situation and or your circumstances. We recommend if you have questions on your individual situation that you follow up with either an attorney or your specific accountant. Please also understand that this information is provided is extremely fluid. Actually, some of the information I put into this presentation changed an hour ago, and so it's changing very often. We're getting further guidance on it. So please know that what you're seeing here, if you are watching this on a recorded and not live, that the information was relevant as of today, which is on Tuesday at 1 o'clock. And so what we present here may change over the next couple days and likely will change. And so please keep that in mind as you look through this. Most of what we're going to be talking about today is going to be a deeper dive into some of the business benefits and incentives that are out there. I'm going to go over the payroll protection program, their economic injury disaster loan, some unemployment things. But I just want to take a minute here to give everyone that's on the call an update on the individual, the recovery rebate credit. That's the $1,200 that individuals are getting, the stimulus checks that are coming in. Those are going to start being issued here this week. The Treasury has indicated that they're going to start processing those on the 6th, which is yesterday. So they're working through that as a work its queue. They've indicated you should receive it by April 15th. When I say should, that would mean if the IRS has your current direct deposit information and you qualified for. As I mentioned in the last seminar, there are several methods to be able to qualify and get those and to get them the information. So you could look at those. Also be careful though, there are a lot of scams that are out there. I was reading one yesterday for a 1-800 number that they've got going on, where you can call and check the status of it and you end up talking to a sexy Russian from Russia, or Russian from, yeah. So watch those, be careful about those. As of right now, from my understanding, there is no phone call to find out and check the status of them. They are coming out. Again, as a reminder, ultimately, if you qualify for the tax credit or this recovery rebate, you can get it on your 2020 tax return. So if you don't see it in the near term, just know that you will be able to qualify and get it down the road. So as we work through this presentation and the information, one thing I am seeing across the board is just information overload and decision paralysis. There are so many options. The stimulus, this package came out. I can name at least 6 different programs that would apply to most of the clients that we work with. And trying to decide which is the right program is very difficult because, again, this came out last Friday is when it was signed into law, and the SBA is just trying to catch up and work things through as our banks and as are the accountants and everybody that's out there. Not to mention the business owners that are trying to either deal with running a business or having to close down a business or go remote. And so there's just so much information. And one of the biggest things that I see is that information paralysis and decision paralysis. So what I've been trying to tell people is you think through this, keep in mind your business is priority. You have to work through those. You're going to have to just slow down and step back. There is a lot of urgency with a lot of these. And so just make sure that we don't make decisions that are rash and too quickly just to get things in because of the hype that's out there. So I titled the presentation today, Alphabet Soup, because I feel like when I'm talking to various different clients here and working through, I feel bad because I just started to use acronyms out there like they've been around forever and everyone understands them. If I say IRS, everyone out there understands that's Internal Revenue Service. But there are so many new programs in here that we're going to be talking about. So I apologize in advance for information overload on this. As it relates on these business incentives that we're going to be talking about today, there's a couple key ones though that I want to start out with talking about. The first one is when I'm going to use the acronym PPP, or otherwise stands for Paycheck Protection Program. We highlighted that last week in our seminar as probably the one that's going to make the most sense for many businesses. So on my illustration here that you see on the screen, I'm kind of comparing them to rocks. And why I've showed you there is you'll see the PPP is different. It's more rigid, it's more strict, it's a little bit bigger, and that's where a lot of the businesses are going to qualify for and go for it. With that said, there are several other incentives that are in the package as well. So there's the EIDL, which is the the Emergency Injury Disaster Loan, as well as an ERC, which is Employee Retention Credit. There's unemployment, and there's a payroll tax holiday, among other incentives as well. But I want to focus on those, the 5 that you see on your screen right now. What I want to point out here is that call it program number 1, or that PPP, that's where a lot of businesses feel they're being pushed towards, which may make sense, but it may not. Know that there's a big push out there for that because that's the one that most banks are aware of, that's the most media is talking about. But as we start looking through this, it may make sense, but it may not. And what I hope to talk about today is just to kind of give you a few examples of where it does make sense and where it doesn't make sense. And hopefully give you at least a guide of kind of a comfort level of knowing what would make sense in general. And why I say that is the PPP program, if you go for that, that's what you get. You get that one big rock. But there's those other 4 programs, and here's the example. Individually, they may not be as big as the PPP program. But when we add them up on top of each other, the pile may get bigger. We don't know. It may be smaller, it may be bigger. So again, each individual business and each individual business owner is going to have to look at what makes sense for your particular situation. And again, I'm going to walk through some of those highlights as well today. The other thing I would make sure before I go into this presentation too far is that you step back and as a business owner, remember that it's not just your operating business that we're talking about. A lot of you are established with an operating business and then a rental company. Well, that rental company qualifies for separate, and you may choose to go with the PPP program for your operating entity, but the other programs for your rental entity. I'd also tell you to think if you're a small business owner and say self-employed, think of yourself that you've got that self-employed business. That is a business. If you have a rental that you might be out there maybe on Airbnb or on some of those other type of rental units, that qualifies for business. And so it's not just one business that you might be thinking of. You got to step back and ask yourself, how many different economic types of businesses do you have that are out there? Now, as I dive in a little deeper, the key thing to keep in mind is the PPP program, which again is the one that many individuals or businesses might choose, is by itself. So that PPP is that one big rock, whereas these other ones, you can pick and choose within those. You don't have to use all of them, but many of them you can overlap on. What you can't overlap is on the PPP against the others. There is a side ability to do a little bit of overlap. There's a mechanism to do it. But in general, here for me on this is that you should really keep the 2 separate. So you got the big rock PPP, and you've got all the little programs that are next to it. So a general overview of what may make sense to do the PPP versus doing the other ones. Where we're seeing, and I would say this, I'm going to make the stat up. So I'm going to even admit it right off the bat that I'm making the stat up. But to give you a general gist of where it is, by dollar volume, the total dollars that we're helping our clients working with, many are going to the PPP on the dollar volume. But on the quantity volume, I would probably estimate about 75% of our quantity of clients are going with the other EIDL and the ERCs and the unemployments. And I'll get into why that makes sense down the road. But as you kind of think through this presentation, ask yourself, where do you fit within this? So in general, again, this is a general statement, where we're seeing the PPP make sense is the workforces that are currently working. So you have not laid off your employees already, where they're either essential services or critical infrastructure, because you're paying the employees anyway. The PPP definitely makes sense in those cases. When you have a high average wage, so if you're paying your employees well over minimum wage, maybe into the 30, 40, 50s, 100,000s of an annual salary, that would make sense. If you're a high benefit employer, some of the PPPs may make more sense. And we're also seeing, and I use the word enterprise operation here, So a larger payroll as compared to, say, smaller business. So the audience I'm talking to here is all fits within small business. So when I say enterprise, I'm not talking Microsoft's or the Amazon's. What I'm talking about is the larger organizations within the small business definition. So what does that mean? I don't know. If it's 50 employees, if it's 25 employees, if it's 100. The point being here is that it's larger than, say, your 1 to 5 employees. Oftentimes I'm seeing those 1 to 5 employees or 1 to 20. There's no magic number on this, but you kind of get what I'm saying is you've got these bigger organizations and the smaller ones. The smaller, call it micro businesses. Those are the ones oftentimes that are fitting into the other programs, and those are making more sense. So let's shift over to that. So we've got with the EIDL, which is the Economic Injury Disaster Loan, the ERC, the Employee Retention Credit, and unemployment. So who's making sense for those? Well, first off, definitely any entity that does not have employees, because the PPP is calculated based on the payroll. Well, if you don't have any employees, then you definitely aren't going to get the PPP. So who would that be? Real estate. So if you have a real estate holding company, the PPP doesn't make sense. You're going to want to look at the EIDL and the ERC. Summer seasonal employers, that's pretty heavy up here where we're at. Really think hard as to whether or not you should use the PPP, because again, the goal, and I'm going to get into this, the goal of the PPP is to pay wages right now. So over the 8-week period from when that loan funds, which is going to be somewhere, let's say April 15th through May 15th, June 15th, somewhere in there. Well, if you don't normally have wages anyway, then that PPP may not make sense. So we're seeing more summer seasonal employers opt more for these other ones. High turnover dollars. The employee retention credit is based on its an employee count, and it's more favorable for, say, lower wage and high turnover. So that's something you may want to look at. Lower average wages. So say your workforce is closer to the minimum wage or the 10 or 12 or 15 or $20 an hour. Those are potentially may make sense for these other credits. Along with that comes lower benefits. And then, or many of the quantity of employers that are fitting into this are, say, the 1 to 2 employees. The sole proprietors or the LLCs that are taxed as an S corporation and they have 1 employee or 2 or 3 employees. Those we see definitely are more often than not fitting into these other programs, and having those may make sense. So again, I'm going to step back and say the PPP program definitely is a huge program, and one that I don't hear me saying that you should be looking at it, but here you're kind of looking at what may make sense for your particular business. I'm going to spend a little time on the PPP program here first. So it's important to understand the intent of this program. So this program was put out by the government to get people back on payroll. It's called the payroll protection. It's not for the benefit of the business. It's for the benefit of the employee, and a little bit, and more so even than the employee, it's for the benefit of the unemployment agencies. The federal government recognized that there is no way that the unemployment agency can handle the sheer volume of transactions that are going to occur during this interim period here. And so they stepped back and said, well, how can we use existing infrastructure to pay those people? It's not that they didn't have the funds are there. It's that they didn't have the mechanism to handle the number of transactions. So when they stepped back, they said, well, let's use existing infrastructure, which is the lending institution, the banks, to fund dollars out to businesses to pay through payroll. That's an established thing. So basically to maintain same as usual. That's the point of the payroll protection program. It's not to help the businesses. It does indirectly help the businesses, but where you see this come into play is you may be saying, well, gee, why would I, as a business owner, pull people back off of unemployment and then just pay them on the paychecks when they're sitting at home because they have to stay home because of the stay home, stay safe order? Correct. That's exactly the point. You're not thinking illogically there. The point of this program is that the government is trying to get you as the business owner to pay people that you otherwise would not do. So if you were to logically say, why would I pay someone who's sitting home? Exactly. That's why they're forgiving these loans. That's why they're giving you this benefit. It's not for the business's benefit. is for the employee's benefit. I say all that because that's going to make a difference when we start comparing between the different programs. Because the payroll protection program, a key component of whether or not that loan is forgiven, and ultimately the end decision, is trying to decide how much is what I'm calling wasted payroll. Meaning it's payroll that you as a business may not have anyway because your employees are on unemployment. That gets back to, if you currently are working, if you're a grocery store, if you're in the transportation, if you're a critical infrastructure, you're a doctor's office, those almost hands down are going to the PPP because you're paying them anyways. There's no wasted payroll there. But then if you look at the ones that are closed right now and are used to getting unemployment, you may err more towards the other programs. And I'll kind of mention here, if you're working in an organization that your employees never have been on unemployment, this is the first thing and they've never had that comprehension, well, you might err more towards the payroll protection program because you want to keep things same as normal. If you're at a business that is used to having their employees are used to being laid off, they've got the systems already in place, well, you may opt to go the other way. So again, the goal of this program is to get employees back on payroll, even if it doesn't make sense to as a business owner. So let's talk a little bit about how to calculate. And here's where the devil's in the details as we start going into this. And a lot of the clients that we're working with that are choosing to go with the payroll protection program are already or have already applied. So there's many banks that worked over the weekend to get through programs. This is a little bit of a cross frustration, if you will, of trying to decide, is it have to be this much of an urgency or not? I had one banker that indicated, and I think this is very appropriate, they've shifted the curve and moved it from the hospitals over to the banks and the accountants. And so now we're just asking to flatten the curve, because right now we're dealing with this just sudden inflow of these dollars coming in and the applications coming in and then going out. So as we're going through this process, you have to be patient that this information is changing every single day. These loan applications are changing every single day. And it's quite frustrating for everybody involved, as well, your bank as well as you. So they're getting information that's different and contradictory to what they were telling their clients yesterday, and then having to go through the whole loan process again. So keep that in mind as we're working through this. But ultimately, the bank is the one that is issuing these funds through. So they're getting guidance from the SBA, but the bank is the one that's walking through. And so we're seeing here as the independent accountant that's working through, and we are interacting with several different clients with several different banks that are out there. Ultimately, it comes to the particular bank that you're working with. We have our opinions on certain things, but it's important to know that if you're working with Wells Fargo, you need to use Wells Fargo's guidance and Wells Fargo's application. If you're using Chase, you have to use Chase's guidance and Chase's application. In theory, they should be the same, but often in the details, they're not. And it goes all the way across the board for whoever you're working with. The key on this program here is to determine the amount is you are using payroll factors to determine this loan and this forgivable loan amount. You then later can use it to pay some other things, but the factor is those other things don't determine the amount that the credit comes out to be or the loan comes out to be. It's based off of gross wages. So think 941s. Many banks are asking for the 941s, plus employer health, plus employer retirement, plus employer state. Note I hit employer there pretty hard. It's the things that you've got gross wages, plus the things that are above and beyond that the employer pays, not the employee pays, because this is meant to reimburse you to keep things going through payroll. So here I showed you an example. I'm not asking you to go into the details of what this is showing you here, but just as an example of saying most of the banks are requiring and having you look through on an employee by employee basis for the period that they're looking at. So they want to see the total compensation that you'd be able to tie back to basically their W-2, or which rolls up into your 941. They're going to see the total wages by person, and then they're going to see the compensation, that's the compensation total, plus you're going to see the health insurance by person, plus the retirement by person. One little caveat here that's oftentimes missed if you're doing the calculation yourself is employer taxes. I want to hit on this employer taxes a little bit. The employer taxes it's not the federal employer taxes. So it's not the federal withholding, because that's not an employer tax. And it's not the federal employer tax. There's only state and local employer taxes. Most of the businesses in Michigan don't have employer portion of local taxes. There are a few, but most don't. Where that really applies to is Michigan unemployment, so SUTA, and Michigan obligation, SUTA obligation. That is an employer tax that needs to get added back. It's small, but I'm noticing many of our clients are missing that when they're doing the calculation. So again, you start with gross wages. Don't use net pay. There's guidance out there that's talking about using net pay. Don't use net pay. That net pay has been superseded. You're starting gross wages. Because you're starting with gross wages, you don't add back the employee withholdings or otherwise. A key within this calculation is the $100,000 per employee. So what that means is if you have a highly count employee, maybe it's the business owner, maybe it's the top management, you cap at 100,000. So the way the calculation starts is you start with total wages and you back off any amount over $100,000. Again, I'm going to reference that we go back to what the bank says. Most banks are utilizing a 12 months ended December 31st, 2019. There are a few banks that are using 12 months ended March 31st. So we see both of those out there. Most are off of December 31st, but we do see both. There is a seasonal calculation that I would suggest you look at. It's not seasonal as in Northern Michigan seasonal. It's seasonal to get to, again, where the intent of this program is, which is over the next 8 weeks. So where they're using that to calculate it is February 15th through June 30, 2019 to determine your seasonal calculation. Now, I'm going to show you this slide here because I was going to present some information on this particular slide. I was prepping for the presentation, and an hour before the presentation started, the IRS came out, or the SBA came out with updated guidance, which completely contradicted what I was going to put in here, and also completely contradicted what many of you have already put in your applications to the bank. And that gets related to that employee retirement, so non-cash compensation, so think health insurance and retirement. Many banks interpreted that to be that was also part of the $100,000 cap. An hour ago, they came through and guidance was issued that says it is not part of the $100,000 cap. And so if you have someone that's making $120,000 on wages, they're capped at 100, but you get to include the health insurance and the retirement for them. So that's a huge change. It does simplify things, which is nice. Some banks were already going that direction. But if not, you should talk to your banker to find out whether or not you should adjust or not. And that gets into whether your loan has already been approved or if it has not been approved. The key within the retirement, though, so now I know I took the X off, is a couple things. One is it's the employer portion, not the employee portion. So you're taking the gross wages plus the employer match. So think if you've got a simple plan, it's the 3%. If you've got a profit sharing plan, that's allowed. So it's the profit sharing plus your safe harbor. And here, this is what got updated, is the cap is not on the 100,000 here for the retirement or the health insurance. Employer health. Again, you're going to hear me hit this pretty hard. It's the employer portion of the health insurance. So what you need to do is back off if your employees contribute. So say you pay for the end premium is $320 a month per employee, but you have them contribute $100. You only get to use the $220,000 or $220. You don't get to use the total amount. So you have to back off what the employee contributes in. We've had a couple questions as to whether that's a dental or vision counts or HSAs. Guidance is showing that anything that it appears that anything that is paid within a qualifying health plan, which means if it's offered equally through a documented health coverage plan, that would be allowed. So medical, so dental, vision, we are interpreting would be qualified as long as it's the same to all employees and available to all employees. Here I'm giving one bank's example of the calculation. Again, use your bank's actual calculation and it walks through. If you need help on it, let us know. We've got reports. If you're using integrated payroll, the reports are going to tie to that. We can help you walk through it as well. We can help you do the application. But if you're doing it on your own, utilize the instructions on the bank's spreadsheets and their applications. It usually is fairly straightforward. So we're going to go through the payroll protection program here. This is just a summary kind of what the calculation is. What I want to hit here is all of that talk, all that last 15 minutes of going through the detailed calculation is just designed to come up with what is the amount that you're going to get, which is I added up the gross wages plus the health plus the retirement plus the employer self SUDA. You take that, you're coming up then with an annual cost, you're dividing by 12 to come up with a monthly cost times by 2.5. Okay, you're taking your wages to determine the amount of this loan. Now this loan is just that, it's a loan. So it starts out as just a regular loan that's coming to you. Now the assumption, as long as you use the proceeds of this package or this loan in the correct way and in the correct time and for the correct things, it's forgiven, but it's not necessarily forgiven. So that's important to think through as we look at what makes sense on this program or others. So again, it's based off of 2.5 times your monthly average. Okay? Why that becomes important is the qualifying costs are only over an 8-week period, but they use that half a month calculation, if you think about it, is designed to pay for the other things that are allowable, which is rent, interest on existing mortgages, utilities, and a few other ancillary items. Now, the SBA came out and put a secondary restriction on this. It was new. This is different than some of the ones I presented in the past, even a week ago, because they came out this last weekend and issued this. This is why a lot of the banks held off, because new information was still coming through. The SBA put a restriction on there that within that loan amount that came through, 75% of it has to be used for, at least 75 has to be used for wages. The other 25 can be used for the other allowable costs, rent, interest, utilities, etc. And so the 75%, you can use more than 75% if you want for wages, but at least 75% has to be. One other question that we get often is it an all or nothing thing? So what if I don't meet this test? Do I have all of it loaned and none of it's forgiven? That is not the case. It's not an all or nothing test. And so the way the calculation goes, if let's say you needed to get $100,000 in wages and you only got to $90,000, then only the difference of the $10,000 would stay as a loan. You'd still be forgiven for the $90,000. And then here, what I've showed you in the presentation that you can download from our website is just an example of the loan forgiveness calculation. And again, what they're doing is they're coming through and saying, what do we think that the amount is going to be forgiven? What I would tell you is that most calculations that we're seeing are assuming that not all of it will be forgiven. It's going to be hard to pull employees back that quickly to get your average payroll. Now, I've internally said here, give me the challenge to spend it, and I will certainly try. And so we should be working through and trying to do what we can. But you should go into this knowing that it's very possible that not all of this is going to be forgiven. Again, you've reduced down your labor, and so you may not pull them back as quickly. This is where, again, you have to step back and say, what is the point of this program? It's not for you to think as a rational business owner that says I should get rid of these employees or put these employees in layoff, not get rid of them, but put them in layoff because we don't need the debt labor. It's to get this paid before and bring them back sooner than you otherwise would. To that point, part of the calculation is also looking at the numbers of FTEs that you had last year at the same time and comparing it to this year. And so as long as you have to pull back those employees on the same quantity as well in order to qualify for full reimbursement or full forgiveness on the loan. Here's a summary sheet, same as the one we presented last week, but try to kind of going through and giving you the examples between the PPP, and now I'm going to shift into the EIDL a little bit. Again, the PPP program is great for many organizations and something that you definitely want to think about for your organization. There is a bit of an urgency on that. If you are looking to do that, I think you need to seriously be thinking about it over the next couple of days. There is definitely strategy on trying to wait to maximize when you get that. The offset of that strategy, though, is the clear, this is going to be far oversubscribed. I mean, we've got President Trump already indicating that if it falls short, which it will, that they want to fund more. Over the weekend, they published that Bank of America had $32.6 billion that they pushed through by Sunday already. Wells Fargo stopped at $10 billion and they capped it. That's all that they were doing. And you've got other banks that were pushing loans through quite quickly through. And so do I think you have to have it in by today or tomorrow? I don't know. But do I think you should really delay too much longer? Probably not. That's going to cause a lot of consternation with a lot of business owners and a lot of bankers out there, but it's that balance. I want to say think about it and delay it longer, but the flip side of it is that there is limited resources and limited dollars, and so you're going to have to keep on this if it's one of the things that you're going to go for. So now we're going to take a step back and say there was the big rock, that PPP program. That's the one that many businesses are going to look for. But I started off the presentation saying that only about 25% of the quantity of our businesses are actually using that program. Big dollars? Yes. But a lot of them are looking at these other programs as well. So I want to now shift and start talking about those other programs. And the nice thing about these other programs is they can pile onto each other. So the one individual program may not make sense, but when you start adding them all together, they may start making sense. So the first one here that we're going to talk about, I'm calling it program number 2, which is the Economic Injury Disaster Loan. Now, everyone's kind of assuming that we're jumping for this forgivable loan because, gee, isn't it nice to get a forgivable loan? But stepping back and asking, well, the whole point of this is that we are hit by an economic emergency. It may make sense, all things aside, that you might as a business just need a loan to get you through that's far exceeding just the amount of the payroll, because you also have bills, you have lumber supply bills that you have to pay, you have gas, you have fuel, you have supplies, you have other costs that are not going to get paid. As you ramp back up, so say in 3 weeks this business, the stay-at-home is lifted, work starts coming back again, but the bills come in a whole lot sooner than the revenue starts coming in. As you start building capital back up, trades are going to take a while to start paying you to get these back. You may find that you really do need a loan. If you jump to the PPP loan, you're walking away from the ability to get these other loans. So be cautious on that a little bit. There is a mechanism, and this has caused confusion on whether or not you can have the EIDL and the PPP. I would tell you that in your minds, assume no. Practically speaking, no. There is a mechanism that if you go for the PPP, you decide later to go for the EIDL, you can pay one off with the other, and essentially eliminating the PPP to go to the other one. It's not really the intent, that's just a back-end thing. So that's where we're really saying if you go to the PPP, that's your one program. Otherwise, you're going to these other programs. Now I'm going to start talking a little bit here on an interim step of this economic injury disaster loan. So if we step back and ask ourselves and watch through the timeline of how this got to where we're getting. This all passed, this CARES Act passed through Trump last Friday, so not 4 days ago, but a week and a half ago. In the world of developing programs, the fact that they're already pushing out a loan for the PPP is earth-shattering, quite frankly, that they pushed it out that fast. Let alone the fact that the SBA has to deal with 5 programs in total. So if the leader of the SBA looked at it and said, okay, thanks, government, or legislation, you just gave me 5 programs that I have to develop from scratch and figure out how I'm going to implement them. Naturally, like all businesses that are stuck by this huge tidal wave of information coming, they said, well, we're going to focus on the one that most businesses we think is going to have the biggest impact, the PPP. So they're putting their resources in developing the PPP program. Well, last Wednesday, the legislation came out and said, SBA, how come you have not issued any programs or any funds out of program number 2, 3, 4, and 5? We gave you all the stimulus money, you're only focusing on the one. How come you haven't pushed anything on these other ones? To which the SBA said, well, good grief, we just got this one, we're working on this one program, let alone these other programs. How are we we don't even know how we're going to disseminate this information, how we're going to go the application, what does it entail, etc. How are we supposed to actually issue dollars out for it? To which the legislation said, too bad, think about it again, we want dollars going out. So what the SBA did is they stepped back and said, well, why would Mr. Business Owner or Mrs. Business Owner even think of asking for an economic injury disaster loan? We've given them a couple general overviews. If you go back on the summary sheet, You kind of know what it is. It's a non-forgivable loan up to $2 million, 3.75% interest for 30 years. Okay, we know about what it is, but we don't know the details. In fact, we don't even know how much a particular business is going to get. What do they qualify for? There's no application to apply for it. We don't know what it is that you're actually applying for. So why would you as a business owner even think of applying for this versus going to the PPP? Well, they stepped back and they said, well, what we're going to do is we're going to say, if you agree to stand in line to hear about this program, we're going to give you $10,000. That's effectively the best way I can describe it. It's not exactly, but that's the best way I can describe it, is think about it as you agreeing to stand in line to hear about a program. And if you agree to stand in line about this program, the first $10,000, even if you don't go for that program, is a loan, or I mean is a grant. So when I'm starting to talk about the EIDL, I'm using that $10,000 as that base amount. This is where if I talk to a business owner and they have a Schedule C and they also own another business, well, that Schedule C might be its own EIDL, or the landlord that has a couple properties, that's its own EIDL. Whether or not you actually use it ultimately for its end goal, which is to have a potentially larger non-forgivable loan, that may make sense, but whether you use that, it still doesn't matter. You still qualify for that $10,000. So everyone that's listening needs to be thinking, okay, which of my different entities should I be thinking about for the EIDL, and which one should I be thinking about for the PPP? Another analogy that I'm using is, think of it a little bit like when you go into Marshall's or a TJ or a Target or a grocery store or a store, and they say, well, you know what, sign up for this credit card and we're going to give you 10% off of this purchase. Those are good deals, but you got to really say, okay, I'm really signing up for a credit card. Sometimes it may make sense to do, other times it may not. So know that you really are agreeing to stand in line to hear about this program, but you can always walk away. And so keep in mind, it is a real loan that you're looking at doing, but you do get a pretty big incentive, so that $10,000, so you got to think about it. So here I'm going to do a little bit about that. It's at $10,000. It's designed to be a quick grant, so it's $10,000 quick. That comes, in theory, it's supposed to be 3 days. Practically speaking, it's looking more like 5 to 6 days, hopefully, then it comes through. One of the caveats in here is you must have been in operation as of January 31st, 2020. Now, we talked about program number 2. That's one of the smaller rocks, but I argue actually it's a fairly large rock. Now let's talk about the other potentially smaller rock, but in actuality it's seeming to be a little bit bigger, which is the employee retention credit. This does not apply if you're self-employed. This is just off of wages. It is a refundable tax credit based off of 50% of the first $10,000 of wages. In general, this is an overstatement, but in general, here $5,000 per employee. So if you remember back to the beginning of the presentation where I was talking about what are some of the organizations that this may make sense for, think about your summer seasonal and think about your high turnover businesses. Those make sense because if you have an employee that works $10,000 or makes $10,000 and then leaves, well, you replace it with replace that employee with another person, you get that credit again. You have that high turnover. Or if you have a large employee base, those start adding up. So $5,000 per employee for the number of employees starts adding up pretty quick. This is another benefit of this particular program is it is not through a bank, rather it's through established tax forms that are going to come through. So it's a predetermined amount, it's a known amount. It's not your immediate shot in the arm, give you dollars in the bank account today. This is your back-end long-range consideration. So when you look at it, you may pair this and combine it with the EIDL, which gives you $10,000 very quickly, and this other $5,000 that's coming in over time, over the next couple quarters as it works through. Now, how do you qualify for this one? So key here is your operations have to be either fully or partly suspended due to COVID. Right now in Michigan, that is the case for this particular quarter. So the second quarter would qualify. Whether or not the third quarter does, that's yet to be seen. Or if you've seen a 50% decline in your revenue, also qualifies to be able to use those wages during that particular quarter. And here's the big, ding, ding, ding section, if you look at it for me, for who I'm presenting to here. If you're an employer that has less than 100 FTEs for 2019, those two qualifiers don't apply. Any wages from the period of March 13th through December 31, 2020 apply. Little caveat there, wages that are paid through for the emergency sick and family leave don't qualify. There's a calculation for it. So again, I want to kind of step back here and start looking at it and saying, okay, well, how do we add these back up? And why would this make sense? Well, let's look at that summer seasonal employer, or maybe the construction company that has already laid off his employees and is looking at the PPP and saying, well, gee, I can get a pretty big PPP program. That's big dollars. But wait a second here. That's just going to turn around and I'm going to pull employees back. I'm a construction company. I'm working on non-essential things. So I don't need to pay those employees. They're comfortable getting unemployment. And I'm just going to take the dollars from one hand and put them into the other hand, and it goes right in, out. Whereas the employee retention credit is going to come to you a little bit later, you being the business and the business owner, and there's no restrictions on how it gets used. It's a tax credit. And so when you look at these, it may make more sense. The number may be less, but it might be more to the business. So again, I'm not pushing or not pushing one particular program, rather I'm asking you to think about what makes sense for your particular business. So I'm going to run through a few examples here to kind of highlight and walk through these. So here's one where, let's say we have a business and they're going to do an EIDL. I'm going to completely ignore the benefit of having maybe you need more on an actual existing loan that's payable. That's a side non-dollar benefit right now. It could be huge, but we're going to ignore that for purposes of these examples. So you're going to get the $10,000 EIDL grant, and then you get the employee retention credit of $73,900. And the calculation for that, by the way, is what I ignored. So I looked at it in this calculation back here, and I added up those 15 employees. So this is the same one that I used in the PPP example before. So if you actually want to see the details on it, I walk through the same example throughout the whole presentation. So here's their salary. You'll see there's some that get limited because they're below, they only made $6,000. Like this particular employee here, number 12, made $6,000 and his health insurance was $4,000, well, that gave him the 10, so he got the full amount. But this one made $6,000, but his health insurance was only $1,800, so he gets lower than the full amount. But we walk through, there's their employee retention credit, assuming they're all qualifying like wages of the $73,000. So I had the $73,900, and for purposes of this particular example, we're going to assume that they're not in employment, they're working, they're going through. So the EIDL is $10,000, the employee retention credit is $73,900. Combined, those two is $83,900. As compared to the presentation I showed earlier in the slide, that particular EID or PPP grant was $133,477. So in that case, probably it's going to make more sense to go to the PPP. We're going to get the quick injection of the dollars, and even if some of that $133,000 doesn't get forgiven, it still may make sense. Now we're going to use the same facts and circumstances, but say we're going to also add into the pile unemployment. So now let's go and shift from maybe being a grocery store that was currently employing people to now a seasonal construction company. And we had the $10,000 for the EIDL, the same employee retention credit of 90 or 73. But we also assume that we have 4 weeks that is during this period where I'm going to call it wasted labor, where the employees are home but not working. So in theory, the PPP would say, well, you're just going to pass those on. And yep, you're going to take those employees back off unemployment and they're sitting at home on the couch. You're just going to pass it through to them. Here, we're saying, well, the employees get the benefit of that $55,000. I just took the same wages of what they would qualify for unemployment just for a 4-week period, gets you $55,000. Now I combine those, and I'm saying the EIDL and the employee retention credit goes to the employer, and the employee still gets the end benefit of the unemployment. That combines to $139,820 compared to the PPP program of $133,000. So in that case, it may make sense to use the other smaller rocks that add to a bigger pile than the PPP. Because in addition, you start having not only the true economic dollar ones add up to be greater, but some of the other non-economic considerations also come into play. For example, What happens if the stay home, stay safe goes longer? So here we're kind of all assuming that, well, right now it's April 13th in Michigan, that the stay home, stay safe is in place. I talk to most people and they kind of assume that's going to get extended on for maybe 2 weeks. What if it gets extended on for another 6 weeks? And so now all of a sudden you're 8 weeks into the PPP, 6 of those your employees are stuck home. So you're really only benefiting for, in that scenario, 2 weeks. Whereas this employee retention credit qualifies for all of those dollars. We're also seeing out there, this is a side unintended consequence, many employees are getting a bonus and a raise to go on unemployment. So the equivalent right now of, with the extra stimulus dollars that are going into unemployment, is that the effective salary, annual salary for unemployment in Michigan is $50,024. So if you were making less than that, to go on unemployment, you just got a raise. So having the ability to pull them back from the PPP program, you may have some unintended resentment by your employees that would prefer to be on unemployment because they're actually making more dollars than they are in the PPP program. I give that to you as a kind of an ancillary. I hope that's not the case, and there's the desire to be same as usual and otherwise. But that is there, and there are employees that are dealing with that fact, employers. And then one other thing here, there's no limit on how, and no restrictions on how the employee retention credit is used. Fundamentally speaking, the employee retention credit is a reduction of taxes. So again, you don't see this big inflow of cash going into your checking account. Rather, you just see less of an outflow. But that outflow is going to generate potentially a greater wealth for you as a business owner down the road. And so, and you're not restricted to having to just use that for payroll or for other things. So here again, I'm going to come back to the pictures and kind of use the picture analogies to kind of show what I have here. So the one on the, and I don't know if it's top left or top right, who knows, the screens are backwards, but one of the screens there shows that the piles are pretty close to each other. Then you might have to decide what's best for your business. What, politically, is it better to have, take people off of unemployment? Maybe that's where engineering firm that they've never gone on unemployment before would make sense because they don't even know how to apply for it or otherwise, your facts and circumstances. The other picture here is the PPP is clearly smaller than the pile of rocks, the individual rocks. And so that one might make sense in your case that you're going to go through the individual ones. Or there's the one here at the bottom where the PPP clearly is much bigger than the individual pile of rocks. So the point of this presentation is not to steer you one direction or the other, rather to present two potential cases. And again, if I step back and say, to help with the decision paralysis here, you've got the PPP program and you've got all the others. You can lump all the others together. And in fact, there's a few that I didn't even mention because they're so small that I would tell you in the grand scheme of things, don't even assume them within the calculations. They're there, you'll get them, but for the calculation, limit the number of decisions that you have to make and go, okay, am I going to go for the PPP or am I going to go for all the others? Knowing that your individual businesses could qualify, so you could do a strategy of both as well. So maybe a PPP for one for your operating and the EIDL for your non-operating. Or you may choose to do all the other ones too. Okay, I'm going to go through just a couple more examples here to really hit these home on the differences. Here's an example where it's a 2-employee company. You're going to get the EIDL of $10,000. You're going to get the employee retention credit that each one of the salaried is $36,000. Maybe they're utilizing an S corporation at a $36,000 and they have additional profits that come later. So you get 2 employees times the 36, but limited to $5,000 each. So there it's limited to $10,000. These particular 2 employees don't want to go on unemployment. And so you can, even without the unemployment, you look at this and you say, well, the employee retention credit gives me $10,000, the EIDL gives me $10,000, combined is $20,000. Compared to if I use the 2 employees times $36,000, so you get up to your combined salary, divide by 12 times 2.5, gets you to your PPP program of $15,000. So not even including unemployment in this particular case, that the ancillary ones make more sense. Not to mention with the fact that you don't have to deal with dealing with the bank for a $15,000 PPP. Here's another example. Oh, and by the way, that other example, if they went for unemployment, it's even that much better. The smaller rocks are compared to the PPP. Here's another example where this one here is a rental, particularly. You get the EIDL of $10,000, and you get it. Yeah, you don't get the employee retention credit because it's zero, because there's no employees, and there's no employees, so there's no unemployment. That's zero. So you get $10,000 for the EIDL, but since there's no employees, and therefore there's no PPP, $10,000 EIDL clearly makes sense over the PPP there. So I wanted to spend a little bit of time here talking about unemployment. And here is where I tell you that I am by no means an expert of unemployment. In fact, generally speaking, we are working with companies that are more taxable than dealing with the unemployment. But I want to give some observations of what we're seeing, just to give you an update in general. One of which is, yes, we're well aware that unemployment does qualify for self-employed individuals. Many clients of ours are self-employed. Even if you're an S corporation within the state of Michigan, if you are an LLC taxed as an S corp, you are still self-employed. If you're a corporation taxed as an S corp, you're a corporation. But an LLC taxed as an S corp, you are still self-employed. As of today, the state of Michigan still has not gotten their website out there for the self-employed. Keep checking back, keep looking at it. If you did do an application and were denied that application, they have indicated, I can't promise it, but they have indicated that they are going to come back and readjust. They're still trying to figure out how to handle self-employed. I've deemed the term and dubbed it, if you will, over the last couple of days, ethical manipulation. And I'm going to acknowledge that those two words should never go together. But that's what self-employed unemployment is going to force people to start thinking about. Is how do I play the game, or how do I manipulate within the confines of being able to do what's right to make sure that you can maximize the unemployment versus the wages that you're getting in. That's what the state of Michigan is trying to figure out how to work around. As you look at it for the self-employed, or just even for the non-self-employed, two things that we're seeing come through on the calculation is the state of Michigan has a max of $362, which is determined based on your historical highest quarter of the last 5 quarters. That limits at 362, so it may determine that your benefit there is 200. It may be 362, it maxes. That's going to determine your particular circumstance for that particular employee. On top of that comes the $600. So if you max, it's $962. What we're seeing, we think, in the state of Michigan is, as a self-employed, you would get $0 for the state of Michigan, and then you get the $600 for the federal. Question that we often get is, well, how do I get that federal? That federal comes through the state of Michigan, so you're still applying to the state of Michigan. It's federal dollars that went to the state of Michigan to then disseminate out to you. Just looking again ahead, we are going to continue to have these webinars here every week, Tuesdays at 1 p.m. So please check back again. These slides will be posted out on the website, our website, entrustcpa.us, as well as integratedpayroll.us for guidance and information. Please check back with us. We're trying to utilize these here to get the information out to people as quickly and as efficiently as possible. I'm trying to reach out, and Jeff is, and Katie is, and Stan and Steve and Andrew and all of us are trying to reach out to our particular clients. But keep in mind that we're doing our best. Please use these as a way of just understanding what's out there. And then following up and scheduling an appointment with us. We do want to talk to you in your specific circumstance. We do want to walk you through the pros and cons in your specific instance to give you a plan and help you with that decision paralysis to really focus on where you should be and what you should be looking at. So, and just thank you. And again, I want to thank you for being our clients or being friends of us, or however. We do appreciate the feedback that we're getting. We thank you for your relationship with us, and we ask for continued patience as we work through this as well. We also are getting inundated on this. I had no intention. Who would have been thinking that I would be presenting a webinar on April 7th, no less, and it had nothing to do with taxes at all. So who would have thought as a tax accountant that I'd be doing that? So please in advance, we're asking for your patience as we work through. We are here, we are working through tax returns. Many of our staff are remote, but we do have staff here at our office to facilitate drop-offs and pickups, both for payroll, for tax returns, for information on these programs. We're here for you, and we're trying to work through this, and we thank you, and thank you very much.